Support and resistance levels trading strategy. What is support and resistance? Support and resistance levels are horizontal price levels that typically connect price bar highs to other price bar highs or lows to lows, forming horizontal levels on a price chart. A support or resistance level is formed when a market's price action reverses and changes direction, leaving behind a peak or trough, swing point, in the market. Support and resistance levels can carve out trading ranges like we see in the chart below, and they can also be seen in trending markets as a market retraces and leaves behind swing points. Price will often respect these support and resistance levels. In other words, they tend to contain price movement until, of course, price breaks through them. In the chart, we see an example of support and resistance levels containing price within a trading range. Note that in the chart, price eventually broke up and out of the trading range, moving above the resistance level. Then when it came back down and tested the old resistance level, it then held price and acted as support. The other primary way support and resistance levels are created in a market is from swing points in a trend. As a market trends, it retraces back on the trend, and this retracement leaves a swing point in the market, which in an uptrend looks like a peak and in a downtrend looks like a trough. In an uptrend, the old peaks will tend to act as support after price breaks up past them and then retraces back down to test them. In a downtrend, the opposite is true. The old troughs will tend to act as resistance after price breaks down through them, then retraces back up to test them. Here's an example of a market testing previous swing points in a downtrend. Note that as the market comes back to test the old support, the level then behaves as new resistance and will often hold price. It's wise to look for an entry point into a trend as it comes back and test these previous swing points. See pin bar sell signal in chart. Because it's these levels that the trend is most likely to resume, creating a low-risk, high-reward potential. How to trade price action signals from support and resistance levels. Support and resistance levels are a price action trader's best friend. When a price action entry signal forms at a key level of support or resistance, it can be a high probability entry scenario. The key level gives you a barrier to place your stop loss beyond, and since it has a strong chance of being a turning point in the market, there's usually a good risk-reward ratio formed at key levels of support and resistance in a market. The price action entry signal, such as a pin bar signal or other, provides us with some confirmation that price may indeed move away from the key level of support or resistance. In the example chart, we see a key level of resistance and a bearish fakie strategy that formed at it. Since this fakie showed such aggressive reversal and a false breakoff of the key resistance, there was a high probability that price would continue lower following the signal. The next example chart shows us how to trade price action from a support level in an uptrend. Note that once we got a clear pin bar buy signal, actually two pin bar signals in this case, the uptrend was ready to resume and push significantly higher from the key support level. The next chart example shows us how sometimes in trending markets, a previous swing level will act as a new support or resistance level and provide a good level to focus our attention on for price action entry signals. In this case, the trend was up, and a previous swing high in the uptrend eventually flipped into a support level after price broke up above it. We can see that when price came back to retest that level the second time, it formed a nice pin bar entry signal to buy the market and re-enter the uptrend from a confluent level in the market. Finally, the last chart we're looking at is an interesting one. Note the swing low that occurred in the downtrend on the left side of the chart. You can see how this level stayed relevant months later, even after the trend changed from down to up. It first acted as a resistance level after price broke down through it. But once that resistance was broken, we had an uptrend form, and then after that, that same level acted as support. And that's where we see the fakie pin bar combo signaling the chart. Tips on support and resistance. Don't get too carried away with trying to draw every little level on your charts. Aim to find the key daily chart levels, like we showed in the examples above. The horizontal lines of support or resistance that you draw won't always touch the exact high or low of the bars it connects. Sometimes the line will connect bars slightly down from the high or up from the low. The important thing to realize is that this is not an exact science. Instead, it is both a skill and an art that you'll improve at. When in doubt about whether to take a particular price action entry signal or not, ask yourself if it's a key level of support or resistance. If it's not at a key level of support or resistance, it might be better to pass on the signal. A price trading strategy, such as a pin bar, fakie, or inside bar strategy, has a significantly better chance of working out if it forms from a confluent level of support or resistance in the market.